The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, 17th day of June. My pleasure to be here Monday through Friday on market days. And, quite a challenge going on there. We had 2 days of very small candles. Today's candle is going to be really important, and I'm going to show you a couple of pictures, and you'll see why. Meantime, back at the ranch, you've got the E-minis down one, having done at 1928.25, having hit round number 1935 earlier this morning. You've got a peak E in the 120-minute chart. You've got two patterns that are fighting one another. And that's representative of both the emotional side and the technical side. When you're looking at this pattern on the right here, if you're looking at Tiger TV, you'll see that the 120-minute chart of the Dow, of the E-mini futures, that's the S&P futures, I drew this in and sent it to my subscribers. Every morning I send out the daily and the weekly E-minis to show what's happening 24 hours, just about 24 hours a day. That's way more important than just the trading day, 9:30 to 4 o'clock, in many respects. In other cases, for the stocks, etc., I think the opening price and closing price are just fine for my work. What's most important is that I showed the pattern that I call the falling axe. That is a long handle, eventually concludes, usually a peak E, a D, E, or F. There's a little doji candle very often, and then there's a pullback where you make lower highs and lower lows. And in this case, that's what the E-mini's done since the 1947 20.25 high on the 9th of June, and it pulls back and it goes to 1917.50. And what happens is there's a little bit of a bounce, but that bounce is walking the 9-period moving average. You can't break away from that at 1926. And there's a downtrend line which I drew, which was hit exactly at 1935. The stochastic and MACD are very poor, and that's saying to me that the internals are weakening, that you might be looking at the price and saying, oh, this is really great. If you're a bull, you say, can't even pull back. There's all this stuff going on in the Middle East and everywhere, and Fed's about to get, there's Fed speak coming up, and they could be saying anything about rates. The market, on a technical basis, saying, oh, wait a minute. It has done well, but there are technical signs that say any weakness that starts to detract from buyers coming in, and you will finally see the volatility index really push higher. I suspect that the volatility index has already started its move to the upside, because so far it's been responding positively to the negative market action. So let me go through a couple of things here. The inverted falling axe formation, let me just draw it in here like that. Oh, you can see it. It's right there. I'll just make it a little thicker right there. Says that there should be resistance in this arch formation somewhere around the 1932 to 1937 area. This is the E-mini. But if there is a pullback, and that pullback takes out the support line. That's the support line that has a trend line support at 1923.5. Well, today's low was 1923.75. It says be very careful on the long side, because we could start to accelerate down. If we take out 1922, 1921 support, this is a real good chance that 1918, the 200-period exponential moving average, will be the target. And I had this data all changed, but I lost it, so I'll have to redo it. But basically what it was saying was somewhere around the 19th of June, within another 2 days or so, if the support breaks, then we could be looking at the 1918 to 1915 area. So I want you to go through it. On the upside, and that's the bullish case, there's this pattern that I call the falling axe formation, just a declining cone after a long move up, 1970.50 low, and the trend line is at 1935. A break, what I said to subscribers this morning, a close, any two bars that start to close above 1920, 1930, let me just double check. I think I said 1931. 1929 to 1931 will start to open up the upside, and then you will see a challenge of the candle with a high of, I didn't say 1940, I was looking at more 1930 and 1935. A close above that will start to indicate that you could go to the 1937, 1941, I think it is. Gosh, I can't remember offhand because the numbers are, I just don't remember the numbers offhand that I said. I could check it out, but you know what? I'm giving them now any close on the 120-minute chart that starts to go to the 1937 area. That's it, 1937 to 1939, and that holds for a couple of hours. That is a couple of two or three bars of the 120-minute chart will be very positive and say, aha, now we can go higher, and we can go to the 1941 area. Okay, got that cleared up. Ooh. So let me give you the numbers. The Dow's down 20 at 18,760. The S&P is down 2 1/4 at 1935. The comp index is up 3 at 43.24. Now this is very interesting. Look at Apple. I finally did the chart. Apple has made a peak F-top at 95.05 in this most recent rally. The weekly is in leg D, so it's only leg D, and with a very strong stochastic and strong MACD. So this is going to be really interesting. Will the daily drag the weekly down? Will the weekly then drag the monthly so it doesn't retest the previous high? In this case, the all-time high was 100.72. And remember, 705 was the high. So what we're looking at here is Apple, quite an important component of the Nasdaq index, is starting to show signs, almost the same chart pattern. A little struggle here. Is this going to be the pattern that I call right there? The pattern that I call. Let me just finish it with that oval. That's the propeller shaft formation that says there's a measured move from the top, 95.05, to the recent low of 90.88. The little bounce with a high somewhere in the 92s, and you get a measured move to the downside, which will take you somewhere towards the moving average, the 32-period moving average, which would be around about 88.71. That's what we're going to be watching for. Or is there going to be a nice reversal based on the 120-minute chart trying to, I don't think it can, but it's trying to form some kind of a base, and it doesn't break under 90. Instead, it goes to 93.50, and that would be at least a minor positive for the 120-minute chart, which would help the daily. So that's going to be very important. Let me just look at the Qs right now. QQQ, 1, 2, 3. The QQQ series. High-level consolidation thus far. Testing the 9-period exponential moving average. The chart as it looks right now, that's not in an hour, that's not in 2 hours, that's not in 3 hours. It's right this second says MACD turned down, stochastics at under 80% at 77%. If the Qs start to trade, or at any point, if they break under 91, that whole 91.90 area support, if a close underneath that says this move is done for the Qs at the moment. But the IWM and this is really so fascinating about the markets. The IWM has missed going to a leg D. The reason why I hadn't been any intention of shorting the IWM, not even the Qs up until now, is because of that internal strength with the MACD still very strong. Oh, look at the MACD and the stochastic on the Qs. Look at that, cross negative. Now, look at the IWM, holding beautifully. Look at that. So I was anticipating that it'll go at least 1 penny above the 117.48 recovery high, recent recovery high of the 9th, and that would start leg D, and at that point, all the little chickens are lined up for a march to the south side. Winter's coming, and they're on their way south. We'll see, because the high today, this is so interesting, 117.25. 117.48 is 23 cents off. 117.20, and I couldn't do anything about this. This is the only count that I've got thus far. There were no phantom peaks or anything. So my suspicion is we've got about a day to go, the rest of the day and then tomorrow, to see whether or not the IWM. But the IWM, because it's under the most important high of 120.58 made in March of this year, the week of March the 7th. This could fail as a single leg A up in the weekly chart, so I'm watching it closely. On the positive side, for the IWM, what would take it even higher is that there was a doji candle high with at 120.58, and the very next month was 120.58, 118.48, and then for only 2 sessions since then, and that was in March, and only 2 sessions since then has the IWM gone under the 9-period moving average. In every case, it closed above it. So that is something you can't dismiss, that the tide in the monthly chart is starting to change, but the sign has just gone up saying high tide at noon, and it's still 11 o'clock, something like that. So I'm watching this one really closely. Now, we had the IYT, which I had spoken about the other day, which is trying to bounce, but it made 2 doji candle tops at 148.18, peak F in the daily, probably leg D, peak D, if there's no move above it this week, above 114.18, and leg E in the monthly. Yet the MACD and the stochastic in the monthly charts, even in the weekly charts to a certain extent, have not yet signaled a major decline, but on the daily iShares Dow Jones Transportation Average, it is showing that there's tremendous weakness internally. So now let's go to what's very important, GCQ14. The gold came off the low this morning. It had a very sharp pullback from yesterday's high of 1285.10. This is the August contract, to the low today of 1258. Hey, that's a big move. Anyway, it's bounced back. The 120-minute chart gave a very nice signal of retesting and then breaking above, and it closed on this 120-minute candle above the high of earlier up until 10 o'clock this morning. 1286, 1269.30 would be very positive, but the MACD and stochastic haven't turned down yet. I'm still looking at gold as being in play, but I need to see how today closes and Wednesday afternoon closes for me to make other decisions about whether I want to implement for subscribers some kind of a long position, either in the gold or one of the indexes or gold stock. So now let's just quickly look at, we're looking at the TLT. TLT is pulled back 74 cents at 111.69. It's so interesting because the chart pattern, the weekly, resembles very much the patterns we're looking at in dailies on some of the indexes. And that's saying that there's some sign of weakness on the price. It is holding okay, but the MACD started turning down. The stochastics plummeted from the 90s, so from the 86 area down to 71% right now. And the monthly chart shows Treasury bond, the Lehman 20-year Treasury bond trust, bumped right into that trend line resistance. We'll go through some of these other indexes. We've got a couple of questions in the den. I'll get to them. Meantime, back at the ranch, Basil Chapman, Tiger Technicians Hour. Love to hear from you. 877-927-6648. I'll be right back. Dow's down 8, S&P's down 1.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Folks, we're back. So there was a question, and good question. TLT, Basil, thanks for the chap wave charts question. Why would you not be short TLT? There are a couple of reasons. One is, in my work, because I do technical analysis, I follow the fundamentals to a certain extent, and at a certain extent it just becomes kind of a blur because you get conflicting opinions about the actual data, and then the data gets changed. But as far as I'm concerned, you cannot rule out that the Fed has articulated quite well that they are in the business of both supporting the stock market, supporting the economy, and supporting lower yields because they want to have people buying houses. They want to have some kind of liquidity out there that they know will have a good chance of floating and flowing into the stock market. And at the same time, a Fed mantra is rarely changed unless conditions dramatically unfold, and even then they'll say, we'll wait for one more Fed meeting to see what happens afterwards. So in the chart that I'm showing right now of the TBT, which is the ultra-short Lehman 20-year Treasury fund, you can see that we've basically been in a trading band. And the TBT has almost got a failure pattern of a C-, and that's the TBT says to have been short bonds, you've had a couple of moments where that was just a perfect thing to do, because from around about July of 2012 into about a year later, bonds were coming down, yields were going up, and now basically we're looking at something very different. However, when you look at the weekly chart, there's a little pattern at the bottom here that says that in this is the middle chart for those of you looking at Tiger TV. I'm stretching it out now. If you're looking at the TBT lower, 59.54, 59.54, made 4 weeks ago, that 9-period exponential moving average is being challenged. And the moment that the TBT starts to rally and start another leg up, if it's not this week, if it's next week, if it goes above 63.90, and then if it closes above 64.20, so it's in the 64s, suddenly what you've got is a chance that the MACD has turned positive. The stochastic moves from 21% to the 28% area, and that should correspond. Now, this is going to be very interesting, to the pattern in the daily having broken the chance of making an arch, another arch formation, a larger arch than has been made before, and starting a different pattern that says, wait a minute, we're finished with the downside. Now you can start your left side, right side price time match, and that could take you very well in the TBT to those upper levels. So one thing, let's go backwards now. In the daily, I would need to see the TBT break above 63.90 in the daily. That's the daily, right? And that would start leg C to the upside. And if the MACD continues powerfully up, as it's quite strong now, but the price hasn't reflected that it should be at a new recovery high, and it's not. And if the stochastic goes from 66% to maybe 77 and then moves up to the 80, that'll be the start of this process. With the Fed in position as it is, my bias right now is to say that the TLT has made a peak A if there's no new high today, and if there is a move in the TLT above the high of yesterday, above 112.63, that trading range that is being set up, and the other thing I must mention is the TLT has broken its very strong up channel that's been a 3 month, 3-4 month up channel, but it keeps testing what was support, testing this line here, which should be red. I don't want it red because now I can make it red, because before I just had it as a price point to watch. So now look at this. There's resistance. I might decide, I considered this morning, what about the TLT? And what I said to subscribers is, if the TLT starts to trade, I think in the 112, did I say it yesterday? I think it was yesterday. TLT, yes, I said it yesterday. What I said is, if the TLT, if bonds rally, the TLT should achieve 115 soon. If market takes a deeper timeout, bonds should benefit. Now, my thinking, let me explain my thinking. The reason why I haven't yet gone either way in the TLT, got a break coming up, but I'm going to say to you, I still think that money will come out of bonds into stocks if bonds start to fall. So let me extrapolate some of that data that I was looking at and put into the perspective that I'm looking at. I'll be right back.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization memorization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Hi, folks. We're back. And to the question of the TLT, that is bonds. There's a pattern that I often talk about. It's a right shoulder pattern. And that's a right shoulder failure. And that right shoulder failure says you've come from the top, you've pulled back. Usually it occurs within one or two troughs to the downside. And then there's an attempt to rally. And that attempt to rally fails as the MACD and stochastic pullback. In my CD, Introducing the Chapman Wave Methodology, the CD book, chapter 20, how is it again? 20, I think it's 21. Yep, chapter 21, slide 363. I show the right failure pattern. I circle and I put little rectangles to show what you look for in the failure pattern technically. And there's another one. It's happened twice, in fact. So what I'm looking at is that if the TLT is going to fail, then I'm anticipating that it takes out 110.83. That's the TLT, 110.83. And that was the low of the, let me see. Yeah, the 10th of June. And if that occurs, that'll start to set off a very negative pattern in the TLT weekly chart. That would correspond. I'll just go to the continuous contract for speed, US. Yeah, that will correspond to the to bonds itself. That's the continuous contract, which is at 135.930 seconds. It's almost exactly the same as your futures contract. That would say that bonds have a chance now to go if they break 134.5, the low of the week of the 6th of June. There's a good chance that rates, and now I'll show you something else, rates will go higher. In my chart, the weekly chart that I call the triple that I'll show my subscribers to my opening call, the 30-year Treasury bond interest rate, it has the 10-year T-note yield, the TNX, and the 5-year T-note yield, the FVX. What this shows is you've made a trough E in the 30-year, only a C in the 10, and only a B in the 5-year. There's been a big discrepancy. It's one of the first times we've had a pullback with such a narrow range to a trough, D or E. And what I'm looking at here is that the yields themselves are actually higher than at other occasions when the yields were together like that at lows, when the 10-year was at 5.41 back in July of 2012, around about July of 2012. The 5-year was at 13.94, and the 30-year was 24.52, 2.452%. So we've had this little cluster pattern. So I think that the idea that this is probably the most vulnerable that the TLT has been at in a long time with the Fed now, because they're very slow to pick up the data, and their data has to be saying that there's been an improvement, a slight improvement, that it's starting to allow them to think more about tightening. And that's really what we're going to see reflected tomorrow afternoon. Within this chart pattern itself, yields have actually been so many times in the last 4 years or so, for 5 years, that the conversation shouldn't even be here in terms of what can yields do, because it's been here so many times. The history is, what is the stock market going to do under these particular circumstances? And I wanted to show you a particular chart now that I've got this. And this is with the OIH, the Oil Service Index. If you're looking at these charts, the only index that is way under its all-time high is the OIH. July of 2008, it was up in the 75 area. Then it went all the way down in 2008 to 27, around about 20. And now it's at 55.19. It's kind of in the middle. All the other indices have had very strong moves to the upside. And the one thing that I care about very much, and I keep doing chart studies in my own work, of what happens when you've got a long, I call it the little snail crawling up a leaf. It's just, what happens when you get a long move to the upside in a very narrow trading range? You created a tiny little channel or a tube. Let's think of it as a tube if you've got this little worm climbing up. What happens when that breaks? Very often what happens when it breaks, and it just takes back bars and bars and bars on the left side. But then, as you get more and more negative because of the speed of how it's happening, that's when you start to see tremendous support. And in this case, for the Dow diamonds trading at 167 in the 167s, the 156 area would be, so there's Dow 156, there's 156, that would be 1,500, maybe 15,600-ish. That, I mean, I'm just talking worst case basis. What happens when they do collapse? And in the SPY trading in the 194s, you've got nothing until 165. Let's call it 166. That area there of support. And in the IYT, that's the transports, it's the same narrow little channel. And the first real support, well, the little tiny support is at 130, let's call it 132. It's at 145 right now. And if it does pull back, you've got nothing really until about 105. So that could be quite serious. Now, as far as the OIH is concerned, this oil service sector, we're looking at a break at the 5560s to the 5571 area back in April of 2011. That's the challenge, and we are right now at 50. We've got a high of 5529. Amazing how charts love to come back to previous levels, and then you get the big test. So, yeah, let me just quickly articulate what I was saying before. In terms of bonds, because the Fed is involved, they've been able to, the dollar, every time the dollar tries to rally, whack, 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 whack-a-mole on the head, keeps knocking it down. Every time bonds try to pull back, push, 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 puff, puff, puff the magic dragon, and we've got bonds trying to be held up. And that's going to be the case until the Fed changes its mind, and probably the worst part will have happened, and then they will announce the change because you'll see it happening already. Now, if I look at gold, see gold, the pattern I'm looking at in gold says unless it's just something really weird that's going to go on, terrible, a big conflict, gold is just in this H that goes through. Remember the pattern that I look at? That's the H pattern. And so chapter 17, let me show you the chart. We've looked at this for years and years and years. This chart here, the H can then go to an M pattern, and that M pattern can even last for a little while. There it is, chapter, this is H to M, that'll be chapter 17, yeah, chapter 17, slide 335 or 476 slides. And look, there's gold doing that exact pattern. Silver has had even less in the monthly chart of a rally. It's flatlined. So silver's going to have to, gold is going to have to lead silver, and then silver might have to catch up and surpass. I don't know. But look at high-grade copper, same thing. Just a flat pattern, rectangle. For months it's been doing that. Now look at platinum, a little bit better, but still it's kind of held its trend line, or it is hugging the trend line, let's put it that way. And look at crude oil. Crude oil is up at the upper part of a rectangle formation, and that says that in the continuous contract, 108 to 110 should be extreme resistance because of the history. If it breaks above that, you're looking at 114 next. I don't want to talk about higher prices because that'll obviously tank the market. So I thought I'd go through those. And here's another thing in terms of the interest rate sector. Every time we get a little shock to what the Fed is expecting, that is not what happens, or it refers to what they were anticipating based on the work that they do, what happens is they hold off for one more meeting. So I just have to look at it that way. So the quick answer is, right now I'm doing nothing in terms of bonds. You can have short-term trades. I think that's fantastic. We got the sell signal. Remember the other day I spoke about it on air. I said in the TLT, I'm getting potential peak F top in this channel, peak D top in this channel. It went right there to 115.19, hit the outer end of the trend line that I drew quite a while back, and it pulled back and it broke the support in this up channel. That's how I like to, in my Master Trader series, we spent quite some time talking about the outer boundaries, the inside track repellent sell zone, and the inside track propellant buy zone. Breaks under that, you have to say, now show me you failed. And you have to prove that you can get back into that. So the answer to this conundrum is that at 113, bonds are saying we're in a trading range. We're going to try to go back towards the 114.15 area. And the major support now, at that point, even now, will be between 111 and 110.70. A break below 110.70, and now we've got something else entirely. So if you are short and you timed it well, I say congratulations. I would just put your stops in, do whatever you have to. Let the price dictate to you the next move. So I hope I answered that as articulately as I can. So here's another question. In the Looking at Apple, we said Apple looked a little bit weak, at least in the short term. Looking at Netflix, had a spike, a gap-up spike, must have been some news, a gap-up spike to a high of, it opens at round number 438. Oh, I love that. 438, round number, and I just leave it there, and we'll see what happens after this. I usually put it in red, not green, red at the top, green at the bottom, and I make it smaller just so it's sitting in the background right there. Boop. No one can see it right there. And it's trading at 442.63, up 12.37. That's up 2.88%. And it's showing strength. That's helping, I think, the NASDAQ. And it's trying to tackle the 458 round number high, where it went from 458 to 299.50. This is a move that, a percentage move that Netflix has rarely seen. 200, I can't remember what I said, 295.40 or 299.40. Missed around number 300, huh? 299.50. So let me type that in, 299.50. And now, and I have to make this green because it's been a huge move to the upside, and it's gotten a V-shaped pattern that says, I might go toward, exactly to, or just above the all-time high, in this case, 458, and at that point, I might become extremely vulnerable. Monthly chart says I've made a peak E. This would be a leg F to the upside. It could be a brand new A. I'm not going to call it an A or a B, I could even say. But in the meantime, I will call it an F if it goes 1 penny over 458. And at this particular point, it's at 448.35, 13 points forward. You can see how quickly it could do that. If it fails to do it this week, but instead starts to pull back, closes under 427, that's the 9-period exponential moving average. That'll be a pattern we've seen very often. I wanted head and shoulders. This is the way I look at a head and shoulders pattern. The 436.04 high of the 10th of June goes sideways, and then it has a single pop-up. If there's even a gap down or a pullback tomorrow or the next day, anytime that Netflix breaks under 436, watch out, because it could come back towards the 427, 421 area, have another bounce, and then start a deeper move to the downside. Why? How would it be very positive if in the next today's Tuesday, by Friday, if it's managed to climb towards the 453 to 456 area, it says, I'm not going to rest until I do something about that all-time high at 458 round number. So those are the parameters. And Google, G-O-O-G, Google is making that H pattern. Couldn't make a leg D in the retracement. It's an H pattern in the weekly as well. I must tell you, the more I look at these, so let me see CMG. I haven't looked at that today. CMG is making a potential doji right here. But it's been a monster, and it's had just successively, even the peaks have been like, excuse me, I just have to go to the bathroom for 1 second. 552.85 was the high on the 2nd of June. 552.50 was peak C, and the next day it breaks out. Peak D doji should have been a turnaround candle to say what happens. It can give you a measure move to the upside from the previous doji, and it's done that. 570.68 is the high. The next day, 568.80. Oh, just 2 points lower, not even 2 points. Oh, it's embarrassing. And the next day, it pulls back to the 9-period moving average, and whoosh, because the MACD is so strong, it goes right up, and it goes to where? Potential doji candle. We've got a break coming up. I'll be right back, and we'll talk a little bit more about what's in store for CMG. Will it make that leg D in the monthly at 622.91 plus? I'll be right back.
take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com. Eastern legend tells of a fair maiden who was offered a rare gift by the king of the land, a bag of pearls. The king promised that she could keep the largest, most perfect pearl she could find with these 3 conditions. 1, choose only 1 pearl. 2, remove 1 pearl at a time, accept or reject it. And 3, if rejected, it would be lost forever. She began by looking at the pearls, passing on many special treasures. She delved deeper into the bag, and soon the pearls were replaced with pebbles. Sadly, she went home empty-handed. Folks, replace pearls with time, because we cannot go back even 2 seconds. We live in the eternal moment of now. So when now are you going to take advantage of my offer to you, a subscription to my daily investment newsletter service, Mastering Probability, where you can experience the most incredible pearls for trading and investing, the Rhodes Momentum Indicator and Strategy. The offer? It gets better. A 30-day money-back guarantee. Don't go home empty-handed. Mastering Probability. Available on the homepage of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Folks, we are back. And of course, CMG. I did so many things during the break that I'd already forgotten. Well, we were looking at CMG's Chipotle Mexican Grill, and just being a monster, absolute monster. And just unstoppable. Even when it has huge pullbacks, it just gets right back on track again. My indicators are suggesting that somehow or other, it only has 622.90. So we are 622.90. That's a lot. It's 100 points. Now, I wonder if it's going to do it in this move or the next move. So I'm just double checking here to see. Yeah. So what I'm looking at here is that there's a peak E making it with a little doji candle in the daily. There's a potential for a doji candle E in the that was a 120-minute chart. Potential E in the daily chart. The MACD is just beautiful, 98%, and just strong as it refuses to come down. Oh, sorry, the stochastic. MACD is still very strong. But I have a hint that we are close to at least a pullback. That pullback could be from 594.50 to test a 9-period moving average of 577.70. Wow. All I can say is that the pattern I'm looking at had the potential to stop dead round about that 568 area to make a right shoulder pattern in the head and shoulders. This is one of the reasons why I'm not a big fan of the head and shoulders pattern, because by the time you recognize it, it's too late to really safely put in a trade. But if you recognize it early, and then it's fantastic. So that's really, I just don't like it, because by the time everything is clear, it's kind of, you've lost a chunk of what would be a really nice trade. So at this particular point, would I short it? I'd have to say this is not one that I'd short at this particular point, not with the strength of the last 4 days, even if it pulls back. If you want a quick trade, maybe. But it's just, there are other stocks that are acting quite poorly with the market up that I would be looking at. So we're about to go to the options hour. The great show coming up. So let me do this real quickly. I'm going to give you my parameters that I'm watching. In the Dow, another little candle. The candle that would have matched very much the candle that I thought was a possibility of that ugly candle. It looked like it might have it this morning, of the 20th of May, of the two candles matching the ones that we just had. So far, that hasn't happened. So it needs at least a down minus 30 to minus 40 to kind of match that pattern. So let me give you the numbers that I'm looking at. If the Dow is able to close today, not at around here at 16,789, but it really tackles the 16,810 to the 16,825 area, I'd say that, you know what, on a short term, the bounce could go a little longer. That's very impressive action. I'm still thinking that there's a chance for a peak D this week with no new all-time high, but we'll have to see what happens. Now, here's the other thing, the volatility index. If that volatility index closes, it's at 1238, closes under 12, that's going to say, oh, man, there is just so, if you're short, then you're going to say, oh, be careful. There's just too much in the way of buying pressure at this particular point. But if by the end of the day it pushes towards the 1265, it doesn't have to take out the high of 1289, just closes above 1265 towards the 1270 area, that'll say, now you're getting a little respect in the VIX, because you're starting to find buyers that are prepared to hold it up even when the market shows some signs of strength. So that's the way I'm looking at it. Make it real clear. Any close in the VIX index this week above 1360, and then it could test the 1392 200-period exponential moving average. Any break below 1150 says, hey, be careful. There's still a lot of strength left. And I'm making it as simple as that. So thanks for being here, folks. Check out my opening call. Got a number of positions. Some of them are working out nicely. Some of them are they've just begun to work. We'll see what happens. Thanks for being here. And I will be with Tom this afternoon. Otherwise, I'll see you tomorrow.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
This is TFNN.